You know what keeps me up at night? It's not the headlines. It's not the talking heads on financial television telling you everything's fine. It's the silence. The deafening silence from the people who actually move markets when something catastrophic is about to unfold. And right now, that silence is screaming. Because silver just crossed a threshold that historically has preceded some of the most violent price moves in commodity history. I'm talking about the kind of moves that create generational wealth for those positioned correctly, and devastating losses for those caught on the wrong side. Let me paint you a picture of what's happening right now in the silver market. For the fifth consecutive year, we're staring down a structural supply deficit. Think about that for a moment. 5 years. That's not a blip. That's not a temporary imbalance. That's a fundamental breakdown in the supply-demand equation that underpins this entire market. The Silver Institute just released data showing global mine supply sitting at 813 million ounces, completely flat year over year. Meanwhile, demand is accelerating across every major category. Industrial consumption, investment demand, jewelry fabrication, all moving higher while supply remains stuck in neutral. But here's where it gets interesting. Here's where the panic trigger I mentioned comes into play. You see, silver isn't like other commodities. It's not just a precious metal. It's not just an industrial metal. It's both. And that dual nature creates a unique dynamic that most investors completely miss until it's too late. Right now, industrial demand is consuming roughly 60% of annual silver production. We're talking about solar panels, electric vehicles, 5G infrastructure, medical devices, water purification systems. These aren't discretionary uses. You can't build a solar panel without silver. You can't manufacture the electronics that power our modern world without it. And here's the kicker. As the world transitions to green energy, that industrial demand is only accelerating. Every solar panel requires about 20 grams of silver. The International Energy Agency projects we'll need to install 630 gigawatts of solar capacity annually by 2030 to meet climate goals. Do the math on that silver requirement. It's staggering. But while industrial users are locked into needing silver regardless of price, something else is happening on the investment side that's creating the perfect storm. Investment demand just surged. We're seeing flows into silver ETFs that haven't been witnessed since the 2020 pandemic panic, but this time, it's different. This isn't fear-driven buying. This is strategic accumulation by institutions who've done the math and realized what's coming. Let me tell you a story that illustrates exactly what I'm talking about. Back in 2008, during the financial crisis, silver briefly touched $21 an ounce before collapsing to under $9. Everyone thought the silver story was dead. Industrial demand was cratering as the global economy seized up. Mines were shutting down. It looked like a disaster. But a small group of investors saw something different. They saw that while demand had temporarily collapsed, supply was being permanently destroyed. Mines don't just flip back on like a light switch. When you shut down a silver mine, you're looking at years and massive capital investment to restart production, so these investors accumulated, quietly, methodically, while everyone else was panicking. By 2011, silver hit $49 an ounce. Those investors who understood the supply dynamics made fortunes, not because they were lucky, because they understood that supply destruction creates price explosions when demand returns. Now, fast forward to today. We're not seeing supply destruction from mine closures. We're seeing something potentially more significant. We're seeing the inability to bring new supply online fast enough to meet accelerating demand. Mexico, the world's largest silver producer, has seen production growth stall. Environmental regulations, permitting delays, declining ore grades, all conspiring to keep supply constrained. Russia is increasing production, but geopolitical tensions mean that silver isn't flowing freely to Western markets. And here's where the panic trigger comes in. The COMEX, the major exchange where silver futures trade, just reported something that should make every investor sit up and pay attention. Registered silver inventories, the metal actually available for delivery, have been declining steadily. We're now sitting at levels that represent just a fraction of the open interest in silver futures contracts. What does that mean in plain English? It means there are far more paper claims on silver than there is actual physical metal available to deliver. It's a game of musical chairs, and the music is about to stop. Now, I need to take a quick aside here because this directly impacts how you might want to position yourself. If you're sitting on $100,000 or more in retirement accounts, I put together a comprehensive guide on how gold IRAs work. And yes, You can hold physical silver in these accounts too. It covers exactly how to get physical precious metals into your retirement account without triggering tax penalties. You'll find it in the description below. It's worth checking out if wealth preservation is part of your strategy. But back to this supply crisis, because what's happening next is where things get really interesting. You see, when you have a structural deficit, meaning demand exceeds supply year after year, something has to give. Either demand has to be destroyed through higher prices, or new supply has to be incentivized through higher prices. There's no third option. And here's the problem. Industrial demand for silver is price inelastic. That's economists speak for saying that manufacturers will pay whatever they have to pay because they can't substitute silver out of their products. You can't make a solar panel work with 10% less silver. You can't build a smartphone with copper instead of silver in the critical components. So industrial users become price takers, not price makers. They have to buy regardless of price. Meanwhile, investment demand is just waking up to this reality. And when investment demand kicks into high gear in a market that's already in deficit, that's when you see the kind of price moves that seem impossible until they happen. Let me give you some historical context that's absolutely critical to understanding where we are right now. In 1979, silver was trading around $6 an ounce. The Hunt brothers, a wealthy Texas family, started accumulating massive positions in physical silver. They understood that the market was tiny, that supply was constrained, and that even a modest amount of investment demand could move prices dramatically. By January 1980, silver hit $50 an ounce, a more than 8x move in roughly a year. Now, I'm not suggesting we're going to see that kind of move. The Hunt brothers were using leverage and manipulation tactics that aren't possible today, but the underlying dynamic, a small market with constrained supply meeting surging demand, that's exactly what we're facing now. Here's another historical parallel that's even more relevant. In 2010, silver was trading around $18 an ounce. The global economy was recovering from the financial crisis. Quantitative easing was flooding the system with liquidity. Industrial demand was rebounding, and investment demand was accelerating as people looked for inflation hedges. Silver went from $8 to $49 in less than a year, a 172% gain. And that was in a market where supply deficits weren't nearly as severe as what we're seeing today. But here's what most people miss about that 2011 move. It wasn't a straight line up. There were violent corrections along the way. Silver would surge 20%, then pull back 10%, surge another 15%, pull back 8%. The weak hands got shaken out repeatedly. Only those who understood the fundamental supply-demand imbalance and held through the volatility captured the full move. And that's exactly the kind of environment we're entering now. The difference this time is that the supply deficit is more entrenched. We're 5 years into structural deficits with no relief in sight. Industrial demand is being driven by secular trends, the energy transition, electrification, digitalization, that aren't going away, and investment demand is just beginning to wake up to the opportunity. Let me break down what's happening in the physical market right now, because this is where you can see the stress building in real time. Premiums on physical silver, the amount you pay above the spot price to actually get metal in your hand, have been elevated for months. Dealers are reporting delays in sourcing product. Mints are running at capacity and still can't keep up with demand. This is the early warning sign. This is what happens when the paper price and the physical reality start to diverge. The futures market might say silver is $32 an ounce, but try to buy 1,000 ounces of physical metal and you're paying $35 or more. That spread is telling you something important. There's more demand for physical metal than the paper price reflects. And when that divergence gets wide enough, when enough people start demanding physical delivery instead of accepting cash settlement, that's when the paper market breaks. That's when prices have to adjust violently higher to reflect physical reality. We saw a preview of this in March 2020. When the pandemic hit and markets seized up, the spread between paper silver and physical silver exploded. You had futures trading at $12 while dealers were charging $25 for physical coins. The market was broken. And when it reset, silver rallied from those lows to nearly $30 in just a few months. But that was a temporary dislocation caused by logistics and panic. What we're facing now is a structural imbalance that's been building for years and shows no signs of resolving. Now, let's talk about what the smart money is doing, because this is where the story gets really compelling. Central banks have been accumulating gold at record pace. Everyone knows that. But what's flying under the radar is that several central banks and sovereign wealth funds have started adding silver to their reserves. Not in massive quantities yet, but the fact that they're doing it at all is significant. Why? Because central banks don't chase momentum. They don't buy at tops. They accumulate when they see long-term value and strategic importance. And they're starting to recognize that silver's dual role as both monetary metal and critical industrial commodity makes it uniquely valuable in a world transitioning to new energy systems. Then you have the mining companies themselves. And this is where the story gets really interesting from a supply perspective. Primary silver miners, companies that mainly produce silver rather than getting it as a byproduct, have been underinvesting in exploration and development for years. Why? Because silver prices haven't been high enough to justify the capital expenditure required to bring new mines online. Think about what it takes to develop a new silver mine. You need to find the deposit, which requires years of exploration. Then you need to prove up the resource, which requires extensive drilling. Then you need to get permits, which in most jurisdictions now takes years. Then you need to build the mine, which requires hundreds of millions in capital. Then you need to ramp up to full production. We're talking about a 7 to 10 year timeline from discovery to production. And companies haven't been making those investments because prices haven't justified it. But here's the catch-22. Prices won't justify it until supply gets tight enough to force prices higher. And by the time prices are high enough to incentivize new supply, you're still 7 to 10 years away from that supply actually hitting the market. This is the supply response lag that creates the most explosive moves in commodity markets. Demand is here now. Supply is years away. Price has to bridge that gap. And we're seeing this play out in real time. Silver mining stocks have started to outperform the metal itself, which is typically what happens in the early stages of a major bull market. Investors are recognizing that leveraged exposure to rising silver prices through mining equities could generate outsized returns. But let's zoom out even further and look at the macro picture, because that's where the real catalyst for silver's next move is brewing. We're living through the most significant monetary experiment in human history. Since 2008, central banks have created more money than in all of previous human history combined. The Federal Reserve's balance sheet went from under $1 trillion to over $9 trillion. The European Central Bank, Bank of Japan, Bank of England, all engaged in unprecedented money creation. And now, even as they talk about fighting inflation, even as they've raised interest rates, the fundamental dynamic hasn't changed. Government debt levels are unsustainable. Deficits are structural. The only way out is more money creation, just under different names and through different mechanisms. What does this have to do with silver? Everything. Because when you debase currency, when you create money faster than you create real goods and services, that excess liquidity has to flow somewhere. It flows into real assets, things that can't be printed, things with intrinsic value. Gold gets the headlines as the monetary metal. But silver has something gold doesn't, that critical industrial demand that creates a floor under prices. You can't demonetize silver the way you might theoretically demonetize gold, because industry needs it regardless of its monetary role. This makes silver uniquely positioned for what's coming. It benefits from monetary debasement like gold, but it also benefits from the industrial demand surge driven by the energy transition. It's the only metal that sits at the intersection of both megatrends. And here's where the geopolitical dimension comes in, because this is adding another layer of urgency to the supply situation. The BRICS nations, Brazil, Russia, India, China, South Africa, have been working to reduce their dependence on the US dollar. They're settling trade in local currencies, they're accumulating gold, and they're securing supply chains for critical materials, including silver. China in particular has been systematically building strategic reserves of industrial metals. They learned from past commodity supercycles that controlling supply chains gives you geopolitical leverage, and silver is absolutely critical to their manufacturing base and their renewable energy ambitions. What happens when the world's largest manufacturer and the world's most aggressive renewable energy installer decides they need to secure long-term silver supply? They start buying. They start locking up production through long-term contracts. They start squeezing the market. We're already seeing signs of this. Chinese imports of silver have been elevated. Their domestic production is being consumed domestically rather than exported. The flow of silver from east to west that characterized previous decades is reversing. This is the kind of structural shift that doesn't reverse quickly. Once supply chains reorient, once strategic stockpiles are built, the market dynamics change permanently. Now, let me address the elephant in the room. The question everyone asks, if silver is so undervalued, why hasn't it moved yet? It's a fair question, and the answer reveals something important about how commodity markets actually work. Silver, like gold, trades on the COMEX futures exchange where massive amounts of paper contracts change hands daily. The vast majority of these contracts are never intended for physical delivery. They're purely financial instruments used for speculation and hedging. This paper market has, for years, been able to suppress price discovery in the physical market. When prices start to rise, large commercial traders can sell unlimited paper contracts to cap the rally. They don't need to have the physical metal. They just need margin to post the contracts. But this only works as long as people accept cash settlement instead of demanding physical delivery. And that's starting to change. We're seeing increasing instances of delivery demands on the COMEX. We're seeing the registered inventory, the metal available for delivery, declining relative to open interest. We're seeing the spread between paper and physical prices widening. These are all signs that the paper market's ability to control price discovery is weakening. And when that control breaks, when enough market participants demand physical metal instead of accepting paper promises, that's when you see the kind of price dislocations that create fortunes. Think about what happened in the nickel market in early 2022. The London Metal Exchange had to halt trading and cancel trades when a short squeeze threatened to bankrupt major participants. Nickel prices briefly spiked over 250% in a matter of days because there wasn't enough physical metal to satisfy delivery demands. Now, I'm not predicting that exact scenario for silver, but I am saying that when paper markets lose control of physical markets, the price adjustments can be swift and severe. And all the signs suggest we're moving in that direction. Let me give you another angle on this that most analysts completely miss. Silver's price has been remarkably stable relative to the monetary expansion we've seen. In inflation-adjusted terms, silver is still well below its 1980 high of $50. If you adjust that $50 for inflation using official CPI numbers, you're looking at over $180 in today's dollars. Using more realistic inflation measures, you're looking at over $600. Now, I'm not suggesting silver is going to $600, but I am pointing out that silver hasn't kept pace with monetary inflation, which means it's been getting cheaper in real terms even as supply has gotten tighter and industrial demand has grown. This creates what's called a coiled spring setup. The longer an asset stays suppressed below its fundamental value, the more violent the eventual reversion to fair value tends to be. And we're starting to see the early signs of that spring uncoiling. Technical analysts are pointing to silver breaking out of multi-year consolidation patterns. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been compressing. Historically, when this ratio falls below 70, it signals the start of silver outperformance. We're approaching that level now, but technical analysis only matters if the fundamentals support it, and in silver's case, the fundamentals are screaming. Let me walk you through a scenario that keeps me up at night. Not because I'm worried, but because I'm trying to make sure I'm positioned correctly for what's coming. Imagine we're 12 months from now. Industrial demand has continued to grow as renewable energy installations accelerate. Investment demand has picked up as more investors recognize the supply deficit. The COMEX registered inventory has fallen to critically low levels. Then something happens. Maybe it's a major mine disruption, maybe it's a geopolitical event that restricts supply flows, maybe it's just a large investor demanding physical delivery. Whatever the trigger, suddenly the market realizes there isn't enough physical silver to satisfy all the paper claims. Prices start to spike. As they rise, more investors pile in, not wanting to miss the move. Industrial users, who've been operating hand-to-mouth on inventory, panic and start forward buying to secure supply. The squeeze intensifies. In this scenario, silver doesn't move 20% or 30%. It moves multiples, because the market is small enough that even modest investment flows can overwhelm available supply. And once a squeeze starts in a deficit market, it feeds on itself until price rises enough to destroy demand or incentivize new supply. This isn't speculation. This is how commodity markets work when supply and demand get severely out of balance. We've seen it in palladium, which went from $500 to over $3,000. We've seen it in uranium, which went from $20 to $140. We've seen it in lithium, which went from $6,000 per ton to over $80,000. Silver has all the ingredients for a similar move: a structural deficit, inelastic industrial demand, growing investment interest, a small market that can be moved by relatively modest capital flows, and a paper market that's increasingly disconnected from physical reality. The question isn't if this happens. The question is when, and more importantly, are you positioned before it does? Because here's the thing about these moves. By the time they're obvious to everyone, by the time they're making headlines, you've already missed the majority of the gains. The real money is made by those who understand the fundamentals before the crowd does. Right now, we're in that window. The supply deficit is real. The demand growth is real. The inventory drawdowns are real. But silver is still trading at levels that don't reflect this reality. That disconnect won't last forever, and when it corrects, when price finally catches up to fundamentals, the move will be swift and substantial. Those positioned beforehand will profit. Those who wait for confirmation will be chasing. So what's the play here? How do you actually position for this? Physical silver is the most direct exposure. Coins, bars, allocated storage. You own the metal, you control the metal. No counterparty risk, no paper promises. Just real silver that you can hold in your hand. Silver mining stocks offer leveraged exposure. When silver prices rise, mining company profits rise even faster because their costs are relatively fixed. A 50% rise in silver prices might translate to a 150% rise in mining stock prices. But you're taking on company-specific risk and equity market risk. Silver ETFs provide easy exposure through brokerage accounts. But make sure you understand what you're buying. Some ETFs hold physical metal, others hold futures contracts. The difference matters, especially if we see the kind of paper-physical disconnect I've been describing. The key is to have a position sized appropriately for your situation. This isn't about betting the farm. It's about having meaningful exposure to an asset that's fundamentally mispriced relative to its supply-demand dynamics. And here's the final piece that ties this all together. We're not just talking about a trade. We're talking about a fundamental shift in how the global economy values and uses silver. The energy transition isn't going away. The digitalization of everything isn't reversing. The monetary debasement isn't stopping. All of these trends require silver, lots of it, more than we're currently producing. And the gap between what we need and what we're producing is widening, not narrowing. This is the panic supply trigger I mentioned at the start. We've hit the point where the deficit is undeniable, where the inventory drawdowns are visible, where the physical tightness is manifesting in premiums and delivery delays. The market is sending signals. The question is whether you're listening. Because in 6 months, in a year, when silver is trading substantially higher and everyone is talking about the supply crisis, you'll look back at this moment and realize this was the opportunity. This was when the fundamentals were screaming, but the price hadn't yet responded. That's where we are right now. The panic supply trigger has been hit. The structural deficit is real. The demand growth is accelerating. The inventory is declining. The paper market is losing control. Everything is in place for a significant repricing of silver. Not because of speculation or hype, but because of fundamental supply and demand imbalances that can only be resolved through higher prices. The smart money is already positioning. Central banks are accumulating. Mining stocks are outperforming. Physical premiums are elevated. The signs are all there for those willing to look. The only question that matters now is, are you positioned for what comes next?